Hi, this is Steve Hutchinson with Hutchinson Family Offices, and with this month's video I want to kind of pick up where we left off and bring up some key issues. First, I want to discuss quickly the post-market overview as a post-election market overview, talk a little bit about what we've seen since the election results were announced and how they've impacted the financial markets. I want to talk about a continuation of our discussion on the end of the bull market cycle, whether we're in that particular point right now or not. And then finally, I want to discuss briefly some tax law changes that I think we need to consider as we close out 2016 as we look forward to 2017. Now, since the election, the markets have responded very favorably. I mean, no doubt the financial markets have been very strong. Although we've seen new highs in the majority of the indexes, we haven't really broken through technically the higher levels on the S&P 500 at about 2,200, which would indicate to me that this might be an additional leg in the bull market. So we're kind of seeing, kind of a slow climb. Also, too, and this is really our opinion, and I'm reluctant to discuss opinions rather than facts, but I think our opinion on this is that this action is more related to the fact that the financial markets had, in the previous 3 months, were very negative. And it's not unusual for the markets to go through a period of negative, not necessarily a correction, but declines and then start resuming it upwards. I think that the financial markets were buoyed by the fact that we saw very strong earnings in a lot of good companies, and those earnings gave a confidence level of moving forward. Now, are these things related or even similar? I'm really not sure. Something is being built into in discussions with cable TV and financial talking heads that tax policy changes may be having an effect. Well, quite frankly, we've got to look at tax policy changes in the context of where they exist, which right now is nothing. We've got a GOP plan. We have a Trump proposed plan. Those two are going to marry up with each other. And if they do make it through Congress and get on the president's desk for signature, we have a tax law change. But right now, the only thing we can discuss is what they're thinking about doing, not what has actually been done. And I'm reluctant to believe that institutional investors and strong investors bet so much on tax policy. In my experience has been kind of like, well, let's wait and see. Now, there are some aspects of the tax policy that are very positive. We're looking at lower rates, although I think it's going to be very candid that folks making between $100,000 on down to $50,000 aren't going to really see much of a tax decrease, maybe $400 or $500. The majority of the tax decrease is going to come to the higher incomes, and quite frankly, it probably should because they pay the majority of taxes in the country. We're going to see some reduced taxes in businesses. The bottom line is business taxes are expected to go down to 15%. That remains to be seen, how they're structured. We're also seeing some changes in the inheritance tax being proposed. So we'll have to see how these tax law changes affect us. Now, if you were to reduce corporate taxes, as we've discussed before in previous videos, yes, you would have an increase in corporate earnings, but people do not buy companies based upon their net taxable income. They base upon their top line earnings. In other words, what they want to see is are the earnings of this company, are they growing? In other words, is Apple selling more iPhones? Is Procter & Gamble selling more diapers? What does that case mean? And that's what investors focus on, which is earnings growth. Now, what is the effects on the market? Well, maybe some of these changes have some effect, but right now we're not really seeing that. We've seen the market maybe move up slightly, and now it seems to be leveling off. So we're not too concerned about that. Now, the second area I want to talk about is the continuation of the discussion on the end of bull market cycle. And the reason I want to bring this up is because I think it's important. I think it's important from two aspects. The first one is diversification. Diversification away from the financial markets. I think it's very important for investors to consider alternative type of investments that do not correlate with the financial markets. And your financial advisor would be able to sit down with you and discuss what those alternative investments would be. But I think that if you're 100% invested into the financial markets, whether your majority of all your holdings are equity investments and bond investments, if we do have an end of a bull market cycle, you're going to get a surprise. It's not going to be very good. And let's take a look at some of these. If I go back and I look at the most recent, the subprime crisis, which started, market correction started or end of cycle was 2007 in October to February 2009. The equity markets dropped 53% of their value, and it took them 4 years to get back to where they started at. We can go back further than that. The internet bubble was from 2000 to 2003. 44% decline. Took about 5 years for that to get there. So the question becomes whether or not these particular cycles, whether or not we can withstand them. Where are we in our financial lives? So it's very important. What we did notice after the election, we started seeing what I don't think it's a negative impact as a result of the election, but it's something with what we would say a reconciliation that the status quo has changed and that the Federal Reserve is going to start tightening, or they're not going to provide as much free money as they have in the past. So we fully expect to see an interest rate increase in December, and with that, we would expect to see the bond market to start correcting. By that, we would expect to see interest rates to go higher and bond prices to head lower. Now that is going to have a big impact on a lot of folks who follow simplified 60-40 rules, 60% equity, 40% bonds. They're going to see the 40% of their bond portfolio maybe move a little bit more to the downside than, say, an equity portfolio would. If you're overextended in equities, you might find yourself in a situation. But let's talk about what creates a correction, or what creates the end of a bull market cycle. Corrections are normal. Let's talk about the end of a bull market cycle. Well, the first one is leverage. And we all know that the bond market is highly leveraged at this particular point. Leverage meaning people are borrowing money to buy bonds. Very similar to what they were doing in 07 and 08 and 09. They were borrowing, 07, they were borrowing money to buy real estate. It was favorable for that, and basically that's it. In fact, really, if we take a look at leverage, if we go back, the investment banks were leveraged 35 to 1 in the pre-crisis. So that's a big issue. Geopolitical, these are unpredictable. We can't specifically point to a geopolitical event that may or may not occur. We are seeing some increase in terrorism around the world. That has a short-term effect. It could have a long-term effect should those terrorists take additional action in more developed countries. But terrorism or other things of that nature. Elections, probably not, depending on who's elected, but most cases it's not. I think the other thing is what creates a correction is are we remaining with the status quo? And what I saw out of the election from a financial perspective is that we rejected the status quo as a nation. And by that, we said that we're not comfortable with the type of capitalism that has been in our country for the last 10 or 15 years, and that we call it crony capitalism, and we want to go back to a more strict capitalism base. So the status quo has changed. Now, how do we look at, how does the Trump administration feed into these equations? Well, first off, I think we're going to see a little bit more pressure on the Federal Reserve to create a more consistent interest rate policy. I think we're going to see some changes, certainly on the geopolitical side, but I think we're going to see a change more or less focusing on more stricter capitalism. Now, our economy is in a very, very bad situation. I'm not going to mince any words about this. We're having very weak economic growth. We have got to see stronger growth somewhere around the 2 to 3. We got to see 3-4% range. We're not seeing strong economic growth, and so this is something that does give us a pause and say, maybe this bull market cycle is going to run its course. Now, one thing I want us to be careful about is understanding why we own companies and why we invest the way we invest. And again, I want to go back to the philosophy is that you don't buy and sell companies, you own them. And so your number one objective in investing in the equity markets, do I own companies that I believe over the long term are going to reward me either with dividends or someone willing to pay me more for the company than I paid for it? Those things are the primary focus of investing in any financial market. So I want to stick very closely to those definitions. Will we see an end to the bull market? Yes, we will. And when it comes, it will be a 20% or more pullback in the market. When that does occur, you need to sit down with your financial advisor before that time. You need to sit down with them today and discuss in detail where do I stand? If my portfolio is to drop 20% of its value, how would my position in my life change? And what can I do to, I don't want to say protect yourself, you can't really ever protect yourself from these things, but what can I do to mitigate that risk? Very, very important. This bull market is long in the tooth, and it would not be surprising if, as we move into 2017, maybe mid-year, to see a significant end to this bull market. I would not be surprised at all. I would like to say I hope it doesn't ever happen, but it happens on a regular basis. Let's talk about tax policy. There are a couple things going on tax policy right now. There's two plans that are being put forth. One is the Trump administration plan, and the one is the House GOP plan. I've read through both of those plans, and let's just be straight, they're pretty close to each other, but we will see some type of change in tax policy. Fortunately for the United States of America, having a world's reserve currency permits us to have the luxury of tinkering with our tax system. In other words, our tax system is a system of rewards and punishments. It's a tremendous privilege that we have as a nation. And we don't tax for revenue. Conversely, we're not like a family where we have to go out and earn a certain amount of money and pay our bills. Government is not a household budget, and deficits, they really don't matter because the government has the ability to tax. It has the ability to change tax policy to basically motivate spending or growth in a particular sector. The government can create dollars to spend on whatever Congress wants to spend it on. So compared to other Western governments, our government taxes at a very low level about 18% of the GDP. So what we're looking at right now is a change in tax policy, and we're seeing that when these tax policies are changing, that incomes, let's take a family that might earn somewhere between $100,000 to $50,000 to $100,000, they're probably not going to see a significant tax cut, maybe a bag of groceries a week, to use a phrase. Most of the tax cuts that are being discussed are businesses being motivated to go back into, release some of their capital and go back and start investing back out and creating more jobs. We'll also see higher income taxpayers pay it. And it's exactly what Mitt Romney said. 47% of Americans don't pay taxes. And that's the strategy that we have to deal with. So what we've got to do is we have huge tax cuts coming from both the GOP plan and the Trump plan. They're going to be somewhere about $4 to $6 trillion into the economy. It's going to be interesting to see how that $4 to $6 trillion comes back. I think it'll be much more efficient than the government. Tax are going to have any enormous effect on a $16 to $18 trillion economy. So these are fairly substantial, and we would expect some result from that. So as we move into 2017, the rule of thumb is, and these are the conversations that we're having today, is that defer income into 2017, accelerate deductions, reduce your taxes as much as possible for this year. Make sure you sit down with your tax advisor or your financial advisor and discuss those strategies in detail. So let's kind of go through our capsulization. Number one, we're pleased to see the markets recovering, although we do not believe it's directly related to what we would call the Trump effect. We think the market was negative for about 3 months, and it's just recovering. We see a breakthrough on the S&P 500 at around 2,200. We're very comfortable with that. Secondly, are we near the end of the bull market cycle? Yes, we still believe we are, and that needs to be part of your plan. And then finally, what can we do to maximize our potential for tax benefits? And that's where you sit down and have some serious discussions about what your strategy should be. That'll do it for this month's video. It's being cut right down here, right around Thanksgiving. I wish all of you a great Thanksgiving, and as we move into the holidays, we're certainly going to have another video between now and Christmas, and we'll keep you posted. That'll do it for this month's video. Thank you.